Have you ever wondered what determines the value of a country's currency? It's not a number plucked out of thin air, but rather, it's a reflection of a range of factors that paint a picture of a country's economic health and global standing. The currency value, or exchange rate, is a key component in the World Economic Orchestra, acting as a barometer of a nation's economic health. This value is not static but fluctuates based on various influences. It dances to the rhythm of supply and demand, sways with the winds of economic indicators like GDP and employment rates, and bends to the will of interest rates set by central banks. It's also shaped by the country's political stability, trade balances, inflation rates, and even its level of government debt. Even global events, speculation, and technological developments can play a part. So, you see, it's a complex interplay of multiple factors that ultimately decide a currency's value. Firstly, let's consider the fundamental economic principle of supply and demand. This principle is as relevant to currencies as it is to apples or cars. Imagine a situation where the demand for a particular currency is high, perhaps because that country's goods or investments are particularly appealing. In such a case, the value of that currency is likely to rise. This is because people are willing to pay more of their own currency to get hold of it. On the flip side, if the demand for a currency is low, perhaps because the country's economic prospects are poor, then its value may fall. People are less willing to exchange their own currency for it, and its value decreases. It's a bit like a seesaw. As demand goes up, value goes up, and as demand goes down, value goes down. So the law of supply and demand plays a pivotal role in the currency value. Next, we look at economic indicators such as GDP and employment rates. These are like the vital signs of a country's economy, giving us a snapshot of its health and stability. Let's start with GDP, or Gross Domestic Product. This is the total value of all goods and services produced by a country in a given period. It's like the nation's economic scorecard. When a country's GDP growth is strong, it suggests that the economy is robust and productive, which can make its currency more attractive to investors. Think of it like a company with impressive profits. It's likely to attract more shareholders, right? Similarly, a country with a high GDP can attract more demand for its currency, potentially raising its value. Now, let's talk about employment rates. Employment is a key indicator of economic health. When more people are working, they're earning money, spending money, and contributing to the GDP. So, low unemployment rates can signal a strong economy. This can boost the currency value, as it reflects a stable and thriving economic environment. Imagine a country where most people have jobs and are contributing to the economy. That's a place where investors might want to put their money, which could lead to a rise in the value of the country's currency. But remember, these indicators don't work in isolation. They're part of a complex economic ecosystem, and they can influence and be influenced by a host of other factors, including those we mentioned earlier, like supply and demand. So, while a high GDP and low unemployment rate are generally good signs, they're not guaranteed to lead to a stronger currency. There are always other factors at play, and the foreign exchange market can be influenced by everything from political events to changes in market sentiment. Thus, robust economic performance often correlates with a stronger currency. But it's only one piece of the puzzle, and it's essential to consider the whole picture when trying to understand why a currency's value is what it is. Now, let's delve into the influence of interest rates, political stability, and economic performance. Firstly, let's examine interest rates. Central banks around the globe use interest rates as a tool to control inflation and stabilize their economies. When a central bank increases its interest rates, it's essentially offering lenders a higher return on their investments. This attracts foreign capital as investors seek the best return on their money. Consequently, the demand for that country's currency increases, which can potentially raise its value. On the other hand, when interest rates are low, investors might look elsewhere for better returns, leading to a decrease in demand for the currency and a potential drop in its value. So, it's safe to say that interest rates and currency value are closely intertwined. Next, we have political stability. It's no secret that investors prefer certainty. Countries with stable political environments are often seen as safer bets. This stability can attract foreign investors, which increases demand for the currency and can strengthen its value. Conversely, political uncertainty or unrest can scare off investors, leading to a decrease in currency value. Finally, let's talk about economic performance. A strong economy is often associated with a strong currency. When a country's economy is doing well, with high GDP growth, low unemployment, and sound fiscal policies, it becomes attractive to foreign investors. This can lead to an increase in demand for the currency and an appreciation in its value. However, if the economy is struggling, with high unemployment and low GDP growth, investors might think twice before investing. This can lead to a decrease in demand for the currency and a potential depreciation in its value. So, you see, the value of a country's currency doesn't just depend on economic factors like interest rates and GDP growth, but also on political factors like stability and certainty. It's clear that political stability and sound economic policies can significantly impact a currency's value. Moving on, let's discuss the role of trade balance, inflation rates, and government debt. Trade balance is the difference between the value of a country's exports and its imports. If a country exports more than it imports, it has a trade surplus. This can strengthen a currency as foreign buyers need to purchase the country's currency to pay for the goods. Conversely, if a country imports more than it exports, it has a trade deficit. This can weaken a currency as the country needs to sell its own currency to buy foreign currencies for payment. Now let's take a look at inflation rates. Inflation is the rate at which the general level of prices for goods and services is rising. Lower inflation rates are generally associated with a stronger currency. Here's why. When inflation is low, the purchasing power of a currency is preserved. This makes the currency more attractive to foreign investors, which can increase demand and potentially strengthen the currency. On the other hand, high inflation can erode the value of a currency, making it less appealing to investors. Last but not least, we have government debt. Government debt refers to the amount of money that a country's government has borrowed. High levels of government debt can be a cause for concern. It might lead to doubts about the country's ability to repay its debts, which can result in a depreciation of its currency. However, a manageable level of government debt can be seen as a sign of a stable economy, which can support a strong currency. So it's clear that the trade balance, inflation rates, and government debt all play significant roles in influencing a country's currency value. But remember, these factors don't exist in isolation. They're part of a complex web of economic conditions and policies that collectively determine a currency's value. So a country's fiscal and monetary policies have a direct effect on its currency value. Lastly, we address the influence of global events, market speculation, and technological developments. It's fascinating to see how the world of finance is intertwined with the happenings on the global stage. Geopolitical events, natural disasters, and global economic crises can significantly impact currency values. Take geopolitical events, for instance. Wars, political unrest, or changes in government can introduce uncertainty, often leading to currency depreciation. On the flip side, peaceful resolutions or positive political changes can strengthen a currency, reflecting increased investor confidence. Natural disasters and global economic crises too play their part. They can destabilize economies, causing a ripple effect on currency values. During such times of uncertainty, investors often seek refuge in what are known as safe haven currencies, typically those of economically stable countries. Then there's the influence of market speculation. The foreign exchange market, with its daily turnover running into trillions of dollars, is teeming with traders and investors speculating on future currency movements. Their decisions, driven by a myriad of factors, can lead to short-term fluctuations in currency values. It's a bit like a self-fulfilling prophecy. If enough people believe a currency will move in a certain direction, their actions can cause that very shift. And let's not forget technological developments, a relatively new player in the grand scheme of things. The rise of digital currencies, blockchain technology, and fintech innovations are reshaping perceptions of traditional currency and its role in the global financial system. For instance, countries that embrace these technologies may see an increased demand for their currencies, potentially boosting their value. In essence, the value of a currency is a reflection of a country's economic health and global standing, shaped by a plethora of factors, from geopolitics to technology. It's a dynamic, ever-evolving entity, responsive to the ebb and flow of global events and advancements. As we can see, even global events and technological advancements can sway the value of a currency. In conclusion, determining the value of a currency is no simple task. It's a multifaceted process, influenced heavily by supply and demand, economic indicators like GDP and employment rates, and interest rates set by central banks. The stability of a country's political environment and its economic performance also play significant roles. Trade balances, inflation rates, and government debt levels are other factors that can sway the value of a currency. And let's not forget the impact of global events, market speculation, and technological developments. These factors are all interconnected, creating a complex web of influences that can push and pull on a currency's value. And remember, the world of currency exchange is subject to sudden and unpredictable changes. Unexpected events or shifts in market sentiment can send ripples through the foreign exchange market in the blink of an eye. Remember, the value of a country's currency is a complex equation, influenced by a multitude of factors both within and beyond a country's control.